This is part 2 of the presentation for Module 6 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs. In this learning objective, we will analyze property, plant, and equipment, including capitalization and depreciation. Property, plant, and equipment is the largest asset for most companies, and depreciation is often second in expenses to cost of goods sold on the income statement. Companies choose the method to compute depreciation, which can markedly impact the income statement and balance sheet. When property, plant, and equipment is acquired, it is recorded at cost on the balance sheet. This is called capitalization, which explains why expenditures for property, plant, and equipment are called CAPEX. The amount capitalized on the balance sheet includes all costs to put the assets into service. This includes the cost of the property, plant, and equipment, as well as transportation, duties, tax, and necessary costs to install and test the equipment. Instead of purchasing property, plant, and equipment outright, companies often enter into long-term equipment leases to increase operational flexibility or to take advantage of attractive financing terms. If the lease terms conveys the risk and rewards of ownership, the equipment is capitalized just like other tangible assets and included on the balance sheet. Once capitalized, the cost of property, plant, and equipment is recognized as expense over the period that the assets produce revenues, directly or indirectly, in a process called depreciation. Depreciation expense is recognized using up of the asset over its useful life. Only assets that have a useful life are depreciated. Land does not have a determinable useful life and is therefore not depreciated. To determine depreciation expense, a company must make 3 estimates, including the useful life, salvage value, and depreciation method. With these 3 estimates, the company can determine a depreciation rate that approximates how the asset is used up over its life. The company uses the rate to systematically decrease the asset's balance sheet value, called the carrying value, such that at the end of its useful life, the asset's carrying value equals its salvage value. When the asset is sold, the difference between the sales proceeds and its book value is recorded as a gain or loss on sale in the income statement. Companies use any reasonable method to depreciate assets. Straight-line depreciation is the most common method in the U.S. and around the world. Other methods include accelerated methods and the units of production method. To illustrate straight line, consider a machine that has a $100,000 cost, $10,000 salvage value, and a 5-year useful life. Depreciation expense of $18,000 is recognized evenly over the estimated useful life of the asset. Depreciation expense of $18,000 per year for the asset is reported in the income statement and as accumulated depreciation in the balance sheet as a contra asset to property, plant, and equipment. At the end of the first year, the net book value of the asset would be $82,000, equal to the original cost of $100,000 minus the $18,000 of accumulated depreciation. Although the word value is included in net book value, it does not refer to market value. Depreciation is a cost allocation concept and not a valuation concept. Accelerated depreciation methods record more depreciation in the early years of an asset's useful life and less depreciation in later years. At the end of the asset's useful life, the balance sheet will still report a net book value equal to the asset's salvage value. The difference between straight line and accelerated depreciation methods is not in the total amount of depreciation, but in the rate at which costs are transferred from the balance sheet to the income statement. Units of production method records depreciation according to asset use. Specifically, the depreciation base is cost less salvage value, and the depreciation rate is the units produced and sold during the year compared with the total expected units to be produced and sold. Modified accelerated cost recovery system is an accelerated method required by the U.S. IRS to calculate taxable income. It is important to note that regardless of the depreciation method a company chooses for its published financial statements, it has no impact on taxes paid. In a prior module, we discussed research and development expense and explained that it includes costs associated with property and buildings to be used as research facilities. Importantly, R&D facilities and equipment are not immediately expensed if they are of general use in nature, such as a general research laboratory that can be used for many types of activities. Then the costs are capitalized on the balance sheet and depreciated over the useful life like other depreciable assets. Only those R&D facilities and equipment that are purchased specifically for a single R&D project and have no alternative use are expensed immediately in the income statement, but this is unusual. It is generally acknowledged that R&D costs, especially development costs associated with clearly defined products for which a workable prototype has been proven, do create future benefits and have the characteristics of assets. However, the measurement uncertainty argument prevails and R&D costs are not capitalized under GAAP. With the exception of general use R&D property, plant, and equipment assets, they are expensed as incurred. In this learning objective, we will discuss gains and losses from asset sales, restructurings, and the computation and disclosure of asset impairments. The gain or loss on the sale of a tangible asset is computed as the difference between the sales proceeds and the net book value of the asset sold. An asset's net book value is its acquisition cost less accumulated depreciation. When an asset is sold, its acquisition cost and related accumulated depreciation are both removed from the balance sheet, and any gain or loss is reported in income from continuing operations. Gains and losses on asset sales can be large, and analysts must be aware that these gains and losses are usually transitory operating income components. Gains or losses on asset sales, whether from the disposal of an individual asset such as a truck or an entire subsidiary, are computed as the difference between the sales proceeds and the net book value. In the year of sale, the computed gain or loss will increase or decrease net income, and the gain or loss reflects estimate errors, not as errors in GAAP in prior period financial statements. A gain suggests that too much depreciation was recorded and that income reported in prior financial statements was too low. A loss supports the opposite. There are at least two ways to handle these sorts of gains and losses in analysis. One is to do nothing. Just accept that prior period income statements and balance sheets are likely over or underestimated due to these gains and losses. Another is to adjust prior periods reports by allocating the gain or loss over the period of the misestimated depreciation and income. To illustrate, in 2018, ExxonMobil recognized a $2 billion gain on sale of assets that were used over the prior 10 years, implying that depreciation expense had been overstated by $200 million in each of these years. To adjust for this, we could decrease depreciation by $200 million per year and increase pre-tax income by the same amounts. Assuming a 20% tax rate, the tax effects of the adjustments are shown on this slide. An important point is that we would only adjust prior year statements to the extent that we use them for analysis and forecasting purposes. Also, the accounting relation that assets equal liabilities plus equity is always maintained in the balance sheet. Tangible assets are reported at their net book values. This is the case even if the market values of these assets increase subsequent to acquisition. As a result, there can be unrecognized gains hidden within the balance sheet. On the other hand, if market values of property, plant, and equipment assets subsequently decrease and the asset value is deemed to be permanently impaired, then companies must write off the impaired cost and recognize losses on these assets. Impairment of property, plant, and equipment assets is determined by comparing the asset's net book value to the sum of the asset's future undiscounted future cash flows. If the sum of expected future cash flows is greater than net book value, there is no impairment. However, if the sum of the expected cash flow is less than net book value, the asset is deemed impaired and is written down to its current fair value, generally the present value of those expected cash flows. To recognize an impairment charge, the company reduces assets by the amount of the write-downs and recognizes a loss in the income statement. To illustrate asset impairment, the footnote to the 2018 Form 10-K for Dean Foods Company reported that it recorded an impairment of $13.7 million for property, plant, and equipment at 5 of their production facilities. The impairments were the result of declines in operating cash flows at these production facilities on both a historical and forecasted basis. It is not uncommon for a company to face corporate challenges that are so great that the only way forward is to alter its organizational, operational, and financial structures. Such corporate restructurings are designed to turn the company around and are frequently initiated in response to poor performance, mounting debt, and shareholder pressure. A restructuring can involve eliminating business segments, selling major assets, downsizing the workforce, and reconfiguring debt. Ultimately, the goal of restructuring is to positively impact a company's long-term financial performance, but in the short term, restructurings usually have large negative impacts on the company's income statement. Because of their magnitude, restructurings require enhanced disclosure, either as a separate line item in the income statement or as a footnote. Restructuring costs typically include 3 components: employee severance or relocation costs, asset write-downs, and other restructuring costs. The first part, employee severance or relocation costs, represents accrued or estimated costs to terminate or relocate employees as part of a restructuring program. To accrue these expenses, the company must first estimate total cost of terminating or relocating selected employees. These costs might include severance pay, outplacement costs, and relocation or retraining costs for remaining employees. Second, the company must report total estimated cost as an expense and a liability in the period the restructuring program is announced. Subsequent payments to employees reduce the restructuring accrual. The second part of restructuring cost is asset write-downs, also called write-offs and charge-offs. Restructuring activities usually involve closure or relocation of manufacturing or administrative facilities. They can require the write-down of assets where the fair value is less than book value. For example, restructurings can necessitate the write-down of long-term assets such as plant assets or goodwill and of inventories. To determine the amount of the write-downs, the company follows the approach previously discussed. It is important to remember that write-downs have no cash flow effects unless the write-down has tax consequences. The table on this slide shows Pfizer's restructuring transactions for 2017 and 2018. Companies are required to disclose the beginning balances of the restructuring liability. Pfizer reports this in the rightmost accrual column at $1,105 million for fiscal 2018. Companies must also report the changes in the restructuring liability for the year, which Pfizer reports separately for the 3 types of restructuring costs. During 2018, Pfizer added $782 million to the liability, which was included in the 2018 income statement, with additional costs relating to other acquisitions for a total of $1,044 million. During the year, the company reduced the liability by $636 million for payment of employee termination costs, asset impairment charges, and exit costs. The ending balance of $1,252 million is reported on Pfizer's 2018 balance sheet as a liability. Restructuring costs consist mainly of 3 components: employee severance, relocation, asset write-down, and other costs. If the company had perfect foresight, it would likely have expensed such costs over the periods it benefited from the employee services and asset usages. As companies do not have perfect foresight, they must expense such costs when they meet the criteria established by GAAP. However, analysts are not bound by GAAP, and they have an interest in formulating financial statements that are most useful for analysis and predictive purposes. In this case, analysts have at least 2 options. First, they can do nothing, just accept that prior periods' income statements likely understate employee and asset usage costs, meaning income is overstated, and that prior period balance sheets likely overstate asset book values because of the understated asset usage cost. Second, they can adjust prior periods' financial statements by allocating the understated employee and asset usage costs to the periods applicable to the relevant employee groups and asset classes. For analysis purposes, Pfizer's 2018 employee termination cost of $459 million were allocated over 3 years, including 2018. The 2018 asset impairment charges of $290 million were allocated over 5 years, including the current year. The other costs of $33 million were considered appropriately expended. This analysis only reallocated the 2018 restructuring costs, but there were also restructuring costs reported in 2017 and 2016, which would also be reallocated as necessary. It is important that an analyst search all available information in footnotes and other releases to gain an understanding of the source of restructuring costs to best estimate the period over which these resources benefited earnings. To adjust each year's income statement, we reverse the current period charge and allocate the charge over the appropriate number of prior periods. These tables show the adjustments for the 2018 termination cost. It is estimated that net income was understated in 2018 when the company recorded large restructuring charges. Net income was overstated in the prior 2 years. The adjustments increased net income by $239 million in 2018. Since the costs accumulate, only the 2016 and 2017 balance sheets required adjustment. 2018 balance sheet was correct. These two tables show the adjustments for the 2018 asset impairment charges. The adjustments increased net income by $181 million in 2018, but decreased net income by $45 million in the prior 4 years. The total effect from both termination, $239 million, and impairment charges, $181 million, is to increase 2018 net income by $420 million, which is about 4% of Pfizer's 2018 net income. The prior year's balance sheets for 2014 through 2017 would be adjusted for the asset impairment charges, but the 2018 would not require adjustment since the amounts are cumulative. In this learning objective, we will analyze property, plant, and equipment. This slide shows information from Home Depot's property, plant, and equipment net of accumulated depreciation and capital lease amortization for the 2017 and 2018 fiscal years. It also shows the depreciation and capital lease amortization expenses for the 2016 through 2018 fiscal years. We will use this data to compute key ratios to assess the productivity of Home Depot's property, plant, and equipment and the assets' relative age. A crucial issue in analyzing property, plant, and equipment is determining their productivity or utilization. How capital intensive are the company and its competitors? To address these and similar questions, we use the property, plant, and equipment turnover ratio. To calculate the property, plant, and equipment turnover ratio for Home Depot, we must first adjust sales for the 53rd week for the fiscal year ended February 3rd, 2019. Home Depot's turnover is 4.8. To analyze this turnover, we would compare it to prior years and to competitors and industry benchmarks. Higher property, plant, and equipment is preferable to lower. A higher turnover implies a lower capital investment for a given level of sales. Higher turnover, therefore, increases profitability because the company avoids asset carrying costs and because the freed up assets can generate operating cash flow. Property, plant, and equipment turnover is lower for capital-intensive manufacturing companies than it is for companies in service or knowledge-based industries. To this point, consider the chart of property, plant, and equipment turnover for selected industries shown on this slide. Turnover or utilization of property, plant, and equipment is widely variable as shown. Capital-intensive industries such as utilities, transportation, and oil and gas report relatively low turnover rates, reflecting large levels of capital investment required to compete in these areas. Home Depot reports that the useful lives of its depreciable assets range from 2 years for furniture, fixtures, and equipment to 45 years for buildings and leasehold improvements. The longer an asset's useful life, the lower the annual depreciation expenses reported in the income statement, and the higher the income each year. It might be of interest, therefore, to know whether a company's useful life estimates are more conservative or more aggressive than its competitors. If we assume straight-line depreciation, which is consistent with the company's policies, and zero salvage value, we can estimate the useful life for depreciable assets as shown on the slide. We compute depreciable assets for 2018 by excluding two items from gross property, plant, and equipment: land of $8.363 million, which is never depreciated, and construction in process of $820 million, which is not depreciated until the assets under construction are completed and placed into service, which is when the company begins to use them. The useful life for 2018 is 16 years, calculated by dividing the average depreciable asset cost by the depreciation expense for the year. We can also estimate the proportion of a company's depreciable assets that have already been transferred to the income statement. This ratio reflects the percent of depreciable assets that are no longer productive and is computed as shown. For Home Depot for 2018, the assets are 62% used up, computed by dividing the accumulated depreciation by the average depreciable asset cost. If a company replaces all of its assets evenly each year, the percent used up ratio would be 50%. Home Depot's depreciable assets are slightly older than this benchmark. Knowing the degree to which a company's assets are used up is of interest in forecasting future cash flows. If, for example, depreciable assets are 80% used up, we might anticipate a higher level of capital expenditure to replace aging assets in the near future. We also expect that older assets are less efficient and will incur higher maintenance costs. This is the end of Part 2 of the presentation for Module 6 for Accounting 311, Financial Statement Analysis for Global Entrepreneurs.